Hey everybody, let's take a look at soybean meal. Soybean meal had a recent trigger with a monthly divergence strategy that I trade, and it implies that there's a fairly significant move to the upside coming for soybean meal. So let's take a look at it. First of all, let's start with what is a divergence. So a divergence is when we're looking for a difference or an anomaly between what price is doing and what in this case, oscillators are doing. I have four oscillators that I watch at the bottom of the screen. So let's start with looking at this lower low that price made on the monthly chart, and then look down here at the detrended price oscillator and the commodity channel index. They were making higher lows. So that's the setup. So we see a discrepancy. We're not looking for when price is doing the same thing as the oscillators. That tells us nothing. We're looking for when the price and the oscillators are diverging. In this case, bullish divergence. So that's the setup. So that doesn't tell us to get into the trade. That's the setup, is identifying this divergence between the oscillator and price. So what triggers us? So basically these horizontal lines mark out the highest high that the oscillators made during the period of the divergence. So for longs, you mark out the highest high. If we were looking at bearish divergence, we would mark out the lowest low that the oscillator made. So that's the first step to finding a trigger. So what actually gets us into this trade is when the oscillator closes beyond, in this case, above that price level that I've marked with the horizontal lines. Okay, so it's important that you hear the word close, because it doesn't matter if it trades above it. The candle has to close, because what sometimes will happen is oscillator will trade up here, and once the monthly candle closes, well, the oscillator is back down here. So has to close. So what did we see? On the detrended price oscillator, the September candle closed beyond this level. So the highest high of the detrended price oscillator was negative 33.93. We see September closed at negative 24.37. That is our trigger, okay? So we've got the setup, we're triggered into the long. So how do we determine targets with the divergence strategy? We start with measuring the full range that price made during the divergence. Then we tack that on to where to where the candle closed, the monthly candle closed. And that gives us this range. So what does this imply for soybeans? Well, from where soybeans is right now, I anticipate a minimum price move of about 17% to the upside, possibly as high as 30% to the upside. So this is a monthly time frame we're looking at. These monthly divergences are significant. They're powerful. When they trigger, we want to pay attention. They have about a 70% win rate, so higher probability that this plays out than not playing out. So how would I place my stops for this trade? I'd use either 150% of the 3-period ATR, or I'd use twice the range of the moving average channel. Those are the two. I'd use whichever one is greater. So it's also important to realize that on these monthly time frames, these stops are going to be quite wide, and the risk is likely going to be too great for a lot of people using futures contracts to use a futures contract for this trade idea. So there are other ways to do it. You could utilize options. That's one approach. And I'm actually not sure if there's an ETF for soybean meal, but if there was, you could maybe use the ETF to get into this trade. So that's the idea, and that is the strategy. That is the setup. I anticipate minimum 17% upside for soybean meal from current prices. If you have any questions about this divergence strategy, feel free to shoot me a message, or for that matter, any questions about trading in general, feel free to shoot me a message. I'm happy to help, and I hope you guys have a great week, and I wish you good luck and good trading.